You already own the stock. A covered call can generate premium, but it leaves most of the downside open. A collar adds the missing piece, a protective put. You give up some upside, and in return, you put a defined floor under a stock position you want to keep. Let us build one. Before we begin, this is education, not personal financial advice. Options involve substantial risk and are not suitable for everyone. Do your own research, understand your broker's rules, and make decisions that fit your own circumstances. A collar has 3 parts on the same stock and expiration. You own 100 shares, buy an out-of-the-money put below the stock price, and sell an out-of-the-money call above it. The put creates the downside floor. The call premium helps pay for that protection, but caps your upside. The key point is simple. You still lose from your entry down to the put strike. Below the put strike at expiration, and while the structure remains intact, further losses stop growing. Start with 100 shares of a stock you are willing to own. Buy the protective put below a level that matches the loss you are prepared to accept. A put delta around minus 0.2 to minus 0.35 can be a useful check. Then sell the covered call above a price where you'd generally be happy to sell the shares, often around 0.2 to 0.35 delta. Net the 2 option premiums. The collar may open for a credit, around 0 or a small debit. The goal is protection first, not forcing the trade to be free. Now the numbers. You own 100 XYZ shares with a $50 cost basis. You buy the $47 put and sell the $53 call, both 45 days to expiration. The call brings in $1.50 and the put costs $1.50, so the net option cost is 0. At expiration, maximum loss is $300. $50 minus the $47 put strike times 100 shares. Maximum profit is also $300 if the shares are sold at $53. Break-even is $50 because the net premium is 0. A true zero-cost collar is not guaranteed. Put skew or higher implied volatility can make the put more expensive, so a small debit is normal. These are expiration values before fees, dividends, tax, and slippage. The lesson is the shape. This is not primarily an income trade. It is a floor. The payoff chart makes the trade-off clear. Below $47, the loss is capped at $300. Above $53, the gain is capped at $300. Between the strikes, the position moves with the stock. You are giving up both tails, the very large loss and the very large gain. And remember, the floor is at the put strike, not at your entry. You still absorb the move from $50 down to $47. At expiration, there are 3 main outcomes. Above $53, the call is in the money, and the shares are likely sold at $53. The put expires worthless, and the position reaches its maximum expiration profit. Between $47 and $53, both options normally expire worthless if they are safely out of the money. You keep the shares and the stock gain or loss runs from the $50 break even. Below $47, the put is in the money and the floor holds. The maximum expiration loss remains $300. Near either strike, do not assume the options will simply disappear. Know your broker's exercise and assignment procedures and decide what you want to do before expiry. A collar makes sense when you want to keep the shares, but you also want a defined downside. That might be a quality holding with large unrealized gains, a cautiously bullish position, or a stock facing a known risk window such as earnings, a Fed decision, or another event. It also suits covered call traders who want to add a real floor. For this approach, I use roughly 30 to 90 days because the put is protecting a multi-week risk. Match the expiration to the period you actually want insured. The protection has a price. First, you need 100 shares per collar, so the stock capital is still substantial. Second, your upside is capped at the call strike. If the stock surges, you may watch gains disappear above that ceiling. Third, the short call can be assigned early. The risk rises as the call moves deeper in the money and can become especially important around an ex-dividend date. If assignment occurs, the shares may be sold while the long put remains open, so the original collar is broken and you'll need to act. Fourth, protection has ongoing cost, either as cash debit or foregone upside, and if the shares are appreciated, assignment and the collar itself can have tax consequences. One more distinction matters. Your profit or loss from original cost basis is not the same as your drawdown from today's price. The put protects a future sale level. It does not rewrite your basis. My 6 rules are straightforward. 1. Collar only stock you still want to own. Insurance does not repair a bad thesis. 2. Choose strikes from real risk and exit levels, not random percentages. 3. Match expiration to the risk window and review the position around 21 days to expiration. 4. Use delta as a check, not as the starting point, roughly minus 0.2 to minus 0.35 on the put and 0.2 to 0.35 on the call is a useful range. 5. Target low or modest net cost, but never pull the call strike closer just to manufacture a zero cost collar. Protection first, acceptable sale price second, cost third. 6. Use liquid contracts. Enter with a multi-leg limit order and log every premium, roll, and debit. Strike selection is where the collar becomes personal to your risk limit. Start with the put. Ask, what is the largest loss I'm prepared to accept? For a debit collar, maximum loss per share at expiration is your stock basis minus the put strike plus the net debit. If the collar opens for a credit, that credit reduces the loss. Then choose the call from the lowest sale price you would generally accept. Only after that do you check delta and liquidity. Move the put closer and you buy more protection, usually at a higher put price. Move the call closer and you usually collect more premium but sacrifice more upside. The net cost depends on both legs and market skew. There is no free insurance. Choose the corridor deliberately. A collar is insurance on a schedule, not a set and forget position. If the stock stays between the strikes and the protection window still fits your risk, hold. If the stock approaches the call strike and you still want the shares, you can consider rolling the call higher. If you need protection for longer, roll the protection window deliberately, usually by moving both option legs to a later expiration, so you understand the new risk profile. If the stock breaks your thesis, do not let the collar become an excuse to stay in a bad position. Exit, record the result, and move on. And if the original risk disappears, close the protection rather than paying for insurance you no longer need. Rolling changes the economics, so treat it as a new decision. You can roll the call up when the stock is near the cap and the thesis remains intact. You can extend the put when the risk window remains. Or you can unwind the collar when the reason for protection has passed. Here is the example. XYZ rallies to $52.50 and the $53 call delta moves above 0.5. You buy back that call for $1.80 and sell the $56 call with the same expiration as the $47 put for $1.10. That is a 70-cent debit. The new maximum expiration profit becomes $530. $6 of stock upside minus the 70-cent roll debit times 100. Maximum loss becomes $370. The original $3 downside plus the 70-cent debit. A planned debit can be acceptable if the thesis remains intact and the revised risk still fits your limit. Log every roll. Never hide the debit from yourself. Avoid 6 common mistakes. Collaring a broken thesis. Selling the call so close that you would resent assignment. Ignoring the net premium. Letting the put expire while the risk remains. Collaring a strong conviction stock where you really want uncapped upside. And forgetting tax consequences. The common thread is simple. The collar should support a deliberate holding decision. It should never become a reason to avoid making one. A quick glossary. A collar is long stock plus a protected put and a covered call, normally with the same expiration. The protected put is the floor. The covered call helps finance it and creates the ceiling. A zero-cost collar means the call premium equals the put cost. It is not free because the upside is capped. Net cost is the put cost minus the call premium. A debit raises your effective break-even. A credit lowers it. And delta measures option price sensitivity to a $1 stock move. Its absolute value is sometimes used as a rough probability proxy, but it is not a guarantee. Put it all together, a collar can turn open-ended stock downside into a defined expiration range while both option legs remain intact. You accept the loss down to the put strike, then the floor takes over. In return, the short call caps your upside and may result in assignment. The discipline is the strategy. Choose the protection level first. Choose an acceptable sale price second. Understand the cost and manage the position before expiry. If the collar makes sense to you, make sure you also understand the covered call leg, because that is what finances part of the protection. You can go deeper in the covered call playbook. And each week, I also publish the US market update covering the SPX, VIX, and the rules we score in public. Practice the structure in a paper account before risking real money. Thank you and good luck with your trading. Educate, discipline, execute.